Hey everybody, welcome back to the channel. Happy holidays to you and your family. Hopefully you're having a good time towards the end of the year here. And in this video, I want to reveal my portfolio. It's been a while since I've shown the positions in my stock portfolio. That's what we're going to do here today. In fact, I'm going to split this out into two different videos. So currently I hold about 25 different stocks in my portfolio. So I'm going to show stock positions 7 through 25 in this video. And I'm going to do a separate video of my top 6 positions because I want to spend more time on those. So if you haven't subscribed to the channel, you want to see those and you don't want to forget about it, go and subscribe to the channel, hit that bell notification. All right, so let's just jump right into this, and we're just going to go from my lowest stock or my smallest position stock in my portfolio and just kind of work up from there. All right, so let's start with my smallest position down here. It's roughly 1% of my portfolio, and that stock is KB Homes, ticker symbol KBH. This is a home builder. Again, it's about 1.1% of my portfolio. Today it's trading at $32 a share. And just to kind of get ahead of myself here, there are other home builder stocks that I bought into, and I'll talk more about why here when we get to the other ones here in a second. Miller Knoll, ticker symbol MLKN. Right now, the price is around $21 a share. It's about 1% of my portfolio. This is a company that sells furniture. There's two companies that came together, Herman Miller and Knoll, to make Miller Knoll. And a lot of times when companies get bought out or they merge, I think the market just misvalues them completely. And I'm not going to say Miller Knoll is a guarantee it's going to go up or anything like that. In fact, none of these stocks is a guarantee. Make sure to do your own research. It's not a recommendation to buy any of these stocks I showed today. But the reason why this one really stood out to me specifically is it has a very, very low PE compared to the overall market. All their multiples are extremely low, and it really fell off once they merged together. And if you look at the industry as a whole, this looks very, very cheap or a lot of value there. Not only that, but they're paying over 4% dividend. It's a company that does produce cash flow. So it was very, very interesting to me based on the valuation. So we'll kind of see how that goes long term. Next one up is Toll Brothers, similar to KB Homes. This is a home builder, about 1% in my portfolio. Right now it's trading around $51 a share. There's another home builder we'll talk about here in a second, and I'll explain why I bought into home builders. All right, so actually the next 3 stocks, I'm just going to reveal them all because they're in the same industry, and it's related to KB Homes, and they are... We have Toll Brothers, ticker symbol TOL, trading around $51 here today, 1% of my portfolio. We have MI Homes, ticker symbol MHO, trading at $47 per share, 1.5% of my portfolio. Then we have Pult Group, ticker symbol PHM, trading at $46 here today, 1.5% of my portfolio. And so these are a group of stocks or group of home builder stocks that I purchased into. I noticed about 2 quarters ago, a lot of different super investors were buying into home builder stocks, including like Howard Marks, for example. But there were a bunch of different ones, and they were not just buying one specific home builder stocks. They were buying a group of home builder stocks. And when I dug into it myself, yes, home builders look like they're in trouble right now with interest rates kind of going up, people having less discretionary spending. We're seeing that the home market in general is falling off. However, the demand for new homes is still there. It's absolutely incredible when you dig into the numbers. So July of 2022, just a few months ago, was the lowest number of houses on the market ever over the last 40 years. And there's just so many new home buyers that are coming into the market that need homes. So I don't think that's going away. Yes, that specific industry is hurting right now, and it's probably going to hurt for a while as interest rates are up. But I think this is a short-term issue, and I do think home builders are going to rebound. Now, I don't know which one is going to do better than the other one, so I'm taking the same approach as other super investors and just buying a group of home builder stocks and just seeing how they run over time. All right, so next stock up here is Generac Holdings, GNRC. Right now it's trading at $92 a share. It's roughly 1.5% of my portfolio. So Generac is the largest producer of generators. In fact, they own 70% of the total generator space. In fact, the second largest competitor to them is Kohler at only 15% of the total market. And they have owned that market for quite a long time, well over a decade. And Generac Holdings, actually, their stock got all the way up to, it was like $400 something a share, and just has crashed. And a big piece of that is that investors were just piling into this company because they were growing like crazy on the top line and bottom line. And this is a company that has a bit of a cyclical nature to it. Now, it's kind of interesting in this one because they can be tied to different events. So for example, if there's power outages that go on and people need to go buy some generators, we saw that in the southern United States over the last like 18 months. So when those events occur, a lot of people go out and buy generators, and it pushes profits, pushes sales up, and ultimately it pushes the stock up as well. At $400 a share, it was bid up way too much, and personally, I think it has fallen way too far. It's an incredible company ran by great management. If you look at all their metrics from ROE, ROIC, their sales per share growth, earnings per share growth has been very, very good over the last decade. Now, they've made a bunch of different acquisitions. In fact, they made around 16 acquisitions over the last 10 years and really going towards clean energy. So I see a lot of people complaining or having pessimism around Generac Holdings saying, they have a lot of gas powered or maybe diesel powered generators. Well, they're going actually into clean energy. There's a strong push for that to natural gas. And that's what a lot of those acquisitions are. So I do think they have a long runway ahead of them. And they're just, I think, a great company to have in my portfolio at this time. All right. So next company up here is Charter Communications, ticker symbol CH. Right now it's trading at $334 per share. It's about 2% of my portfolio. In fact, I own another stock in this space, which we'll talk about here shortly. So this is actually a stock I bought fairly recently. I think it took a big dive because the market just put too much emphasis on their spending over the next few years. So management came out just in the last quarter and said, hey, we're going to be putting a lot more money back into the business. And so there could be a lot more expenses over the next couple of years, and their stock just took a dive on that. But similar to Generac Holdings, I think it's just been pushed down too far. I think they have a very long runway. This is a company that has done very well for investors over the last decade. Warren Buffett is one of those who owns this stock as well. So I think long term, it's going to do well, in my personal opinion. Next one up is Fidelity National, ticker symbol FIS. Right now it's trading on $67 a share. It's about 2.5% of my portfolio. This is a company that is in the payment processing industry, and this is a stock that has taken a big dive over the last 6 months. What got interested me in this stock is that a couple of super investors that I follow closely bought into this stock. I dug into it. I did buy a small piece of my portfolio into it, but at the same time, this one is a bit concerning to me because the multiple that the market has been willing to pay for this company has been very, very high, like 40 plus in the past. And that to me is very, very concerning, especially with the economy kind of faltering. And I do think we're going into a recession. So I don't want to make this a bigger position than it is right now. They do pay a decent dividend around 3%. Which is interesting for a high growth company like this. But I do think it's in an interesting position as far as pricing right now. But that's kind of my thoughts there. Next one up is Carvana, ticker symbol CVNA. Right now it's around $4 a share. This is a company that was trading at $350 a share. It's gone all the way down to $4 a share. It's around 2.5% of my portfolio right now. Carvana is in trouble. It really is my personal opinion. If I had to put a number on it, I think there's a 30% chance right now that it could go bankrupt. I really do. This is a company that I think they have an incredible business model. In fact, if you dig into it, you'll find out that they do have a strong moat in their industry. In fact, they save about $1,400 in savings per car compared to the average dealership and compared to their competitors. So what the heck happened to Carvana? Why have they fallen so much? My personal opinion is management has made some terrible decisions this year. When I bought into this stock, it was prior to their Odessa acquisition that they made in April of this year. And what happened is that they were growing so much. This is a company that had triple digit growth going back to 2021. And the company believed that they were going to continue to grow at a very, very high clip. And so they put growth over everything else. They went and bought a company called Odessa, and Odessa owns about 56 different sites around the United States. And basically they auction off cars. In fact, they're the second largest auction company in the United States. They are a profitable business, but Carvana overpaid for the business. They paid about $2 billion for Odessa. Not only that, but then they also borrowed another $1 billion so they could recondition their sites. Now, there is some positive things that came out of that. They can now reach about 90% of the entire country. That's Carvana. So Carvana is a company where you can go onto their website and you can look at used cars and buy used cars from them. So they're a used car e-commerce business. In fact, they're the largest e-commerce business that is out there. And the reason why I have not sold Carvana yet is because of their business model, and they are continuing to eat up their space, even though that their sales dropped this past quarter, and I think they will continue to drop over the next quarter or two, certainly, or at least their growth is going to significantly slow down versus what where they have been. But at the same time, they've been eating up their market share space. The problem is at $4 a share right now, their balance sheet is absolutely terrible. The Odessa transaction, they got a 10% bond, which is just absolutely ludicrous in my personal opinion. So they may have dug themselves such a deep hole at this time, they may go bankrupt. If it goes under $1 a share, Carvana doesn't have a chance in my mind. They're going to have to claim bankruptcy because, there's things they could do to get above $1. So if you guys don't know, public companies have to keep their stock price above $1, whether on the NASDAQ or the New York Stock Exchange. If they don't keep it above $1, they're going to get a letter in the mail, and they have so much time to get it above $1 or they get delisted. Companies can do these reverse stock splits to push their stock up, but typically when they do that, even though it doesn't necessarily hurt investors' monetary value of how much they own of the company, the market looks very unfavorable to companies that do reverse stock splits because that usually means they're in trouble, and the stocks in general typically fall after that. There's a lot of selling that goes on. So they're not too far off from $1 right now. So we're going to see how things go. I do like the business model, but I don't know. We're going to see if management can pull through or not, but it's looking bad for them right now. All right. So next one up is 1-800-Flowers, ticker symbol FLWS. Right now it's trading on $10 a share. It's about 3% of my portfolio. This is a company that I certainly have talked about on my channel a bunch before. Most people would recognize this company as if you want flowers delivered to you. Who actually uses a 1-800 number anymore? Nobody does for the most part, right? But they do so much more than that. They have Sherry's Berries. They have Moose Munch. They have not just food that they deliver, but they also bought a company called Personalization Mall from Bed Bath & Beyond, where you can go on there and buy different trinkets and stuff for, maybe it could be your mother, or maybe you're having, a bachelor party, you want to get some stuff engraved for your groomsmen, that sort of thing. So they own, I think it's 15 or 16 unique brands within it. It is a profitable company, but unfortunately when we see the economy faltering, 1-800-Flowers is just not going to do all that well. When discretionary spending goes down, so does 1-800-Flowers profits and sales. So long term, I think they're going to be okay, but certainly as we're in a recession, it's just rough on the company. unfortunately. Next company up here is Comcast, your symbol CMCSA. Same space as Charter Communications. Comcast is about 3% of my portfolio. Right now, the stock is around $35 a share. This is a company, I think the dividend's around 3.5%, 4%. I think it's closer to 4% right now. This is a company that I think has a monopoly in a lot of different parts of the United States as far as cable and internet. I know where I live, I mean, there's another carrier that you can get, but they do not do nearly as well. The internet is not nearly as fast as Comcast. So they pretty much have the whole city I live in and other cities around us. And they are getting into the streaming space as well. So even as cable kind of deteriorates over time, I think they're still in a very, very good position from a streaming standpoint with Peacock, but also, you know, with being able to provide internet and even phones. I actually know a number of people that have Xfinity phones, or at least their Xfinity phone service that is considerably cheaper than a lot of other carriers. In fact, I've thought about even moving over to them as well. Next company I want to talk about is Reservoir Media, ticker symbol RSVR. Right now, it's around $6 a share. It's about 3.3% of my portfolio. This is certainly one of these smaller companies in my portfolio at around $366 million market cap. So this is, I think, considered a micro cap when it comes to a size of a company. And Reservoir Media is just so fascinating to me. Most people probably have no idea about what this company does, but they are the first independent music publisher to go public. Now, the biggest two companies in their space is Warner and then also Universal. In fact, Warner and Universal own between 60 and 80% of the space, depending if you're looking at music recording or music publishing. So those two companies are the giants in that space. And then you have a ton of different other companies that kind of take up the rest of it. And Reservoir Media is one of those companies, but I think their CEO is fantastic. She's won all kinds of different awards. The company's been around for over a decade. And their intellectual property is so much different than, you know, say like a pharmaceutical company, say that you get a drug and you only have like 20 years to produce that drug before another company can start making generic drugs of that, for example. Reservoir Media, when you own music, you know, you have a much longer runway. It's somewhere around, I'm trying to do the top of my head, but it's somewhere around like 90 to 95 years that you own that particular music right to that song. Not only that, but you have rights to songwriters as well that you have to sign on and have a relationship as well too. So I just think it's really, really fascinating business overall. I wouldn't buy too much more than it is right now just because it is such a unique space, and I feel like I'm learning something new every single week about this specific industry. But I really like their CEO a lot. I think she's made a ton of great choices. One thing that, you know, has to be considered here is that they grow not just from organic growth. So they think they're going to be growing around 15 to 18% organically, but buying other companies, buying other music. That's kind of how they end up really growing over the long term as well. So it's just interesting space overall. All right, so next one up here is Adobe, ticker symbol ADBE. Right now it's trading at $338 a share, almost 4% of my portfolio overall. Massive company, you know, $157 billion market cap. Adobe, I think, is one of the best 10 companies in the entire world. I think they have an incredibly wide moat. If you're a content creator, if you work on the computer in general, it's very highly likely that you own or use one of their products on a daily basis. And I think they have a very sticky product, from Adobe Acrobat to other products and services that they sell overall. The one concern I do have about Adobe is that the market has always paid a very high multiple for them. And I just don't know if that's always going to be the case. So we'll kind of see how things go forward. But I just think Adobe is just an incredible company overall. Next up here is Douglas Emmett, ticker symbol DEI. This is a REIT. This is the only REIT that I own. In fact, I typically don't own REIT because I don't understand their moat, or what kind of gives them an advantage over other people or other companies in that industry. And why Douglas Emmett stood out to me specifically is that they're only in really two markets. So they're in Los Angeles and they're in Honolulu. Those are two of the biggest cities in the entire world as far as GDP goes. And Los Angeles specifically, they own a lot of office space there, and Los Angeles, there's just not a lot of places to build anymore, so they can't have a lot of competitors just coming into that area and start building buildings. It's just not going to happen. In Honolulu, a lot of their portfolio over there is rentals or leases of single family homes, for example. So I think they're in two really, really great markets. They've always paid a really, really solid dividend. Now, it did dip from like 6% down to around 4.5% here recently. But I do think they have a long runway. I do think REITs, though, will have some issues going forward. A lot of hybrid working, things that are going on in that type of environment or business in general. But I think, at least especially in the Los Angeles area, I do think that big companies still need to have office space for their customers and for their own employees there too. But that's one that I think is in a really good space right now. Another one is Netflix, ticker symbol NFLX. Right now it's around $295 a share, about 4% of my portfolio. Similar to Adobe, market's always paid a high multiple for Netflix, which I'm a little concerned about going forward, but I do think Netflix has a strong moat. Netflix is a streaming service I use the most. I also like HBO a ton too. My wife likes Hulu, which is part of Disney. But I do think Netflix is in a really good place in their space. They create a lot of unique content. I always get concerned about other streaming companies like a Fubo TV, for example, that doesn't have unique content, that doesn't create their own content and own those specific rights to it. I think that was smart for Netflix to get into that a few years ago. They obviously have taken a beating this past year, but I do think they have a good runway going into the future, and I do think the international space is going to continue to grow for them, but I am concerned about their future multiple that the market will pay for them, but we'll see how things roll out. Next one up is Stanley Black & Decker, ticker symbol SWK. Right now trading on $74 a share. It's about 4.5% of my portfolio. Stanley Black & Decker owns a bunch of different great brands. So they own Craftsman, they own Stanley, Black & Decker, they own DeWalt, Cub Cadet, Troy Built. They own a ton of different fantastic brands. So if you are a carpenter or you're in construction, or even if you do a lot of home projects, you probably own one of their brands. And they're a dividend king. They've been paying a dividend for around a century. In fact, they've had increasing dividends for over 40 years. The stock has taken a beating this year. They do have a new CEO as of this past summer. They did take on some more debt, which I did not like over the last 12 to 15 months. So they need to deleverage themselves going forward. It's one of the reasons why their stock got worse. Their balance sheet is not as good as it was, say, 15 months ago. And they need to get their inventory down as well. But I do think long term, it's a fantastic company. Next company I want to talk about is Tencent Holdings, ticker symbol TCEHY. This is a Chinese company. Now, this market cap says $3 billion. That's actually in Hong Kong dollars, so that's not completely accurate as far as United States dollars or USD. So just keep that in mind. It's trading around $40 a share. It's almost 4.5% of my portfolio. They have a huge moat with WeChat or other products or services that they own. But what's really fascinating to me is their portfolio stocks that the company owns. They have an incredible track record of compounding of 30% plus. They buy into really small companies or companies that they deem have high growth, and they've done an excellent job on hitting on a ton of those. So it's just a unique business just in general. And also gives me access to the Chinese market overall. All right, so next one up here is Alphabet, ticker symbol GOOGL, Google. Massive market cap, over $1 trillion, around $89 here today. It's a 5% of my portfolio right now. Google, I mean, most people know Google. I mean, they have just an incredible moat. They own all kinds of different services and products. Obviously, you're watching YouTube right now, which is it's one of the largest products or services that they offer. But I think just recently with the announcement that they bought the NFL ticket for around $2 billion a year, I think it's going to fly under the radar because I think there's a lot of people out there that want to cut cable. They're sick of paying high dollars and they have all these channels. They don't use 90% of the channels. Instead of going to, say, a streaming service where they can pick specific channels that they want. But the issue is a lot of times they don't get the sports with it, right? But YouTube, you can go to YouTube TV and get a bunch of channels there and then also be able to get the NFL Sunday ticket. I think this could be huge for Alphabet and Google going forward. We'll have to see how it plays out. But even without that Sunday NFL ticket, I think Google is a tremendous business. Now, I don't think they have a margin of safety like a lot of other companies that are out there. But even still, I think it's a tremendous company that has a long, long runway in front of it. All right, so next one up here is Warner Brothers Discovery, ticker symbol WBD. Right now it's trading on $9 a share. It's about 5% of my portfolio overall. So this is a company where Warner Media, which was owned by AT&T, spun off, merged with Discovery, and now they're called, obviously, Warner Brothers Discovery. So you have two huge giants coming together and trying to harmonize and to create this huge legacy of content that they're trying to put out. So Warner Brothers Discovery owns Warner Media, which is one of the largest film producers out there. I think they're like the second largest one. And then you also have Discovery, which has a bunch of different unique content or channels specific to them, like HGTV and much more. They also own, the Harry Potter series. They own the DC universe. In fact, they have the largest legacy content portfolio that is out there, over 200,000 hours of watch time. The problem with Warner Brothers Discovery is when they merged, they took on a ton of debt. So there's about $40 billion of debt that came over from Warner Media, from AT&T. And currently they're sitting on over $50 billion of debt. Now they've paid off over $6 billion this year, and they have to continue to deleverage their balance sheet. At the same time, they're trying to harmonize these two large companies. So they have a lot of things going on with them right now. And I've said on my channel, even to my Patreon members, I'm not even looking until 2024 to see a lot of these seeds and positive growth and trajectory for this company. I just went through an acquisition this past year with my company, and our company was much smaller. The company that bought us was over $100 billion. And it is absolutely tough when two companies come together, especially two large companies like Warner Media and Discovery. So that's why I'm saying it's probably going to take 2 years to actually seeing really positive results from this merger. And it's probably going to take 7 to 10 years before they're in a really, really good space overall. Nonetheless, I think it's really good value. Obviously, you got to dig in yourselves and figure it out. The debt situation is not to shy away of, and you should certainly be aware of that. But if the company can get back to the same operating margins of around 15% that Discovery had before the merger, the stock price is going to be well over $30 a share in my personal opinion, but we'll see eventually where that falls. So those are my stock positions 7 through 25. Like I said earlier in this video, I'm going to do a separate video of my stock positions that are 1 through 6, so my 6 biggest holdings separately. Some more time with those overall. If you're interested, I do show an update of my portfolio every single month on my Patreon. You also get access to my valuation templates, my Discord channel, and also posts or analysis I do not provide to YouTube on there, which I'll put a link in the description below if you want to go check that out. Thank you so much for watching the video. I'm curious to know, do you own any of the stocks that we mentioned in this video? Do you hate any of these stocks? Love to hear from you in the comment section. Thank you so much for watching. I'll catch you on the other side. Take care and God bless.